Today, we will explore several data points about the Brazilian stock market and highlight factors that suggest potential catalysts for a new upward cycle. This analysis is based on a report from BTG Pactual. I forgot on Brazilian. BTG Pactual, the largest investment bank in Latin America. First, disclaimer. This video is for education purposes only. It's not a stock recommendation. I'm not a licensed financial advisor. Do not make your decisions just because you watched an awesome YouTube video. Do your own research or talk to a professional before investing. This first chart is fantastic because it shows us the growth of assets under management by local funds. Assets under management by Brazilian funds have reached 7.4 trillion reais. Of this, only 622 billion, about 8.4%, are allocated to equities, basically stock market. Put simply, if you invested $100,000, about 8,000 would be in stocks, while the remaining 92% would be in other investments, mainly fixed income, meaning lending money to a bank or to the government. This chart also reveals a negative correlation between the Brazil's benchmark interest rate, taxa Selic, and equity exposure. From 2002 and 2008, with rising commodity prices and falling interest rates, equity exposure grew from 11% to 22%. During that cycle, many stocks were stretched. Banco do Brasil, Vale, Petrobras, all of them experienced a strong upward cycle. Conversely, between 2012 and 2016, when interest rates rose, equity exposure fell from 14% to 8.5%. From 2016 to 2020, with lower rates, exposure climbed again to 15%. Today, we are back in a high interest environment, and equity exposure is of course declining. This suggests that when interest rates eventually fall, billions could migrate from fixed income into equities, fueling the next rally. Despite the recent rise in the Brazilian market, equity exposure remains low. In the next chart, we see a short-term zoom into monthly fund allocations. Notice that equity exposure has been slowly increasing since the beginning of the year. The question is, did this allocated volume grow because of new inflows, or was it simply due to the rise in the stock market? We haven't had significant new inflows. In fact, there have been more withdrawals from equity funds. The inflows were concentrated in fixed income. Equity funds have seen 57 billion in withdrawals this year, while fixed income funds attracted 163 billion. Yet the market continues to climb, a sign that price appreciation rather than new inflows is driving exposure higher. For the past 5 years, equity fund allocations have been stagnant, with net monthly flows consistently negative. In other words, frequent redemptions have been happening. Sentiment toward equities remains weak, while fixed income dominates with 4.2 trillion reais under management, of course, with a 15% interest rate compared to just 631 billion in equities. With this information in mind, I want to highlight the points that I see as creating a compressed spring effect that could trigger a rally in the Brazilian market. Oh, and just for the record, we are already in a rally since dividends were taxed. The companies are paying more than expected now since the tax comes to an effect next year. But also next year we have elections, so I'm expecting a lot of volatility. So, first point, capital closings. We have fewer than 400 companies listed on the Brazilian stock exchange. As investable companies leave the market, the number of available companies to invest in shrinks. In fact, since 2022, we haven't had a single IPO, meaning no new company on the Brazilian stock market. Therefore, if money flows into the market, it will be directed toward a smaller number of companies. And as we know, high demand with limited supply means higher prices. Second point, reduction in free float, referring to the number of shares in circulation and available for purchase. This is due to share buybacks by companies and controlling shareholders increasing their stakes. Thus, once again, we have fewer shares available to buy, fewer companies and fewer shares. Third point, the prospect of lower interest rates. If this really happens, appetite for equities will tend to grow. Not to mention that a lower interest rate environment stimulates the economy, which could increase revenues for many companies. It also helps financial results, since many companies carry debt. Therefore, both revenue growth and reduced financial expenses could boost corporate profits. This would also lead to higher dividends, and since part of the dividends are reinvested in the market, this becomes another additional resource that could drive prices higher. Fourth point, record levels of assets in fixed income funds. If people's attention to equities increases, there is a large stock of resources in fixed income that could be redirected to equities. Notice that the average equity fund exposure is around 12 to 13%. So calculating 7.5 trillion times 12%, there should be about 900 billion allocated to equities. Today, we have 622. A quick reflection, foreign inflows this year were about 25 billion, which helped lift several stocks. Now imagine if, over time, more than 200 billion were directed to the market. The result would indeed be an upward cycle. Fifth and sixth points. Foreign inflows remain weak in the Brazilian market. You are not investing in Brazil. Invest in here so that I can make money. I'm joking. For those who don't know, this channel is my way to practice English with a hobby of mine, investment analysis. So don't take me too seriously. Anyway, retail investor is also weak. I mean, retail investors represent a small percentage of trading volume, around 13%, even though we've reached a record number of individuals and active accounts in Brazilian stock exchange. But retail participation in equities has been declining in recent months, now representing 12.5% of trading volume, whereas they once represented more than 20%. And finally, if the rally continues, FOMO, fear of missing out, could also kick in. When an investment starts delivering returns, people get excited, thinking it will rise forever. Afraid of missing out on gains, they accept buying at higher prices. Well, that's it for today. We've discussed several interest data points about the Brazilian stock market. Were any of these insights new to you? What did you think? The Brazilian stock market is showing signs of resilience despite its weak inflows and high interest rates, with multiple compressed spring factors in play, including fewer listed companies, reduced free float, the prospect of lower interest rates, and a massive pool of fixed income assets. The stage is set for a potential new cycle of growth. When will it happen? Well, we don't know. Thank you for watching. I'm the Brazilian investor, literally from Brazil. See you next time. Muito obrigado, forte abraço e até a próxima.